Hello everyone, welcome to Obed FX Academy. Once again, this is not a gambling channel. This is not a get rich quick platform. This is a channel dedicated for Forex education. So without wasting much time, I'll let you click on the link in this description to join the Telegram channel. So let's move straight into what you are going to do today. That's first match, the journey of teaching Forex from scratch. So we have to first focus on what the knowledge. Knowledge comes first before investing or putting your knowledge in or putting your money in whatever you've learned. So now we decided to first focus on the knowledge. Knowledge first before you put your money or put your capital into what you are doing. So we are going to begin with what introduction to what financial markets. So we are going to discussing what understanding Forex from foundation to institutional level. So this is presented by, of course, me, Obeda Samoa. Let's move on to the next slide. Okay, so we are going to move. What is Forex? So what is Forex? So foreign exchange, which is what Forex is, the global marketplace for trading currencies. So and it is the largest financial market in the world. It operates what do I mean by the largest financial market in the world? The financial market consists of crypto stocks, but Forex the largest financial market in the world, and it operates for 24 hours a day, 5 days a week. But for crypto operates for 24/7. 24 hours a day, 7 days a week throughout. But Forex operates what 24 hours a day and 5 days a week. So daily trading volume exceeds 7 trillion, which means every single day over $7 trillion pass through this market. So you have the chance as a retail trader to just capitalize on this money that is flowing through this financial market. Let's move to the next slide. So why Forex exists? So Forex exists because international trade requires what currency exchange. During international trade, there is what currency exchange, USD to GBP. So there is exchange of what currencies. This is why what Forex exists. So if this currency or international trade doesn't exist, what Forex is also not exist. So business need what foreign currencies as the same as international trade. Investors move capital across borders. There is money moving across from Ghana to China, from China to US. There's capital moving across borders, and government also manage monetary policies. So this is why Forex exists. Let's move to the next slide. So next one is what the structure of the financial market. What is the structure of the financial market? So the structure is what it's in an hierarchical order. That's from the highest to the lowest. So from these major participants in the market, we have what first the central banks, moving on to the commercial banks, hedge funds, corporations, and what the retail traders. We are the retail traders. So let's move on to the next slide. This is the structure of the financial market. So what someone asks, what's the role of what central banks? So central banks, which is also part of the major structure in the financial market, they control interest rates, they manage money supply, they stabilize currency. So example of these central banks is what the Federal Reserve, we have the ECB, we also have what the Bank of England. These are the rules of what the central banks control, manage. Now that let's move to the next slide. So what is being traded? Some ask Forex, they are always trading. So what is being traded? So what we call for Forex is what we trade currencies. We trade currencies. What is currency? So example is what Euro USD. We trade currencies that they are traded in what pairs. Pairs. We have Euro USD is the example, Euro USD, GBP USD. So you speculate on which currency is stronger, then you trade it, right? Let's move to the next one. Okay, so we are going to discuss the next, which was understanding currency pair. What do I mean by when I say Euro USD? There is an understanding behind it. This channel is mainly for education, understanding the knowledge. So base, when I say base currency, when I say Euro USD, Euro is the base, right? So as is indicated on the screen, that's base currency is the first, and quote currency is what the second. So when I say Euro USD, USD is what the quote currency. So if price rises, when we have prices rising, we'll say bullish. It's bullish. We'll talk about it later. So when price rises, what the base is what strengthens. So when I say GBP USD rises, that means what GBP what strengthens, right? The base. So if price falls, we see what the quote strengthens. So falls, that means what the quote, which is what the USD as what strengthens. Let's move on to the next slide. On to the next slide, which is this we're going to discuss our next one, which is what major currency pairs. What do I mean by major currency pairs? It's major when you say major, what's the majority, right? So it includes USD. As you all know that USD has been a very dominant currency, a very, very dominant currency. So example of the major currency pair, when you say pair too, so like major currency pair, example is what? Euro USD, GBP USD, USD JPY. Why do we say they are major currency pair? They are major currency pair because they have high liquidity. What do I mean by liquidity? Liquidity is money. We'll not talk about that one today. Liquidity is money. So a lot of cash flows through it. A lot of money is in it. Money flows through that pair. That's why it's what is the major, because a lot of people throughout, even USD is accepted globally. So it's definitely proves that what has high liquidity. And when you say high liquidity, it has what low spread. Spread is what the commission or the charge that the brokers charge for placing a trade. So when there are a lot of people participating in the market, the cost of trading is what reduces. That's why it's what has lower spreads. Let's move to the next one, which is going to talk about minor currency pairs. What do I mean minor currency pairs? They do not include USD, right? So we have examples like Euro GBP, Euro JPY. These pairs are very, very volatile. They are volatile than the major pairs. Let's move on to the next one, which is what exotic currencies. When I say exotic currencies, what exotic currencies? They include one major currency versus what an emerging currency. So examples is what USDTRY, USD ZAR, that is South Africa. We also have high spreads and what high volatility. So if you learn what major currencies, minor currencies, and what exotic currencies. Let's move to the next one. That's what moves the market. Okay, we've learned the forex market. We have knowledge about it, how it works, the structure. We are moving on to what moves the market. So economic news moves the market. So right now, the war that is happening, the US, Iran, it is causing massive movement in the market. Gold is just buying gold, oil, and BTC. They are just moving up and down. So economic news was moves currency. The interest rate, when they raise or cut interest rate, it moves the market. Inflation, GBP reports, political event, that is COVID-19, other political issues, they cause what movements in the market and high impact economic news, especially when Trump has really, really moved the market. So high impact economic news move the market, right? Let's move to the next slide. I want to talk about interest rates, the major driver. I'm taking interest rate because what that's the major driver that moves the market, right? Although we have political news, but it's not always. But for interest rate, they most of the time move the market. So rising rates, the currency strengthens. When I say that the rate is rising, when the Bank of England increases their rate, so then the currency is what strengthen, right? Rising rates, that means the currency strengthens. So investors would seek higher returns, capital flow into higher held economy. So interest rates really, really move the market. Most of the time, a lot of people are looking at the interest rate, what is happening to the rates. It really, really moves the market, right? Let's move to the next one, which is what high impact economic news. High impact economic news. We have NFP, that's the non-farm payrolls. A lot of traders are in for this news. This news, a lot of traders waiting to trade NFP. You see traders saying it's CPI, it's NFP. These are all news. That's what move the market. Let's move to the next. What forex market sessions? The forex also has what sessions. So when I talk about Sydney session, people say I trade during Sydney session, I trade during London session, I trade during New York session, I trade during what London or New York overlap. These are all time which is indicated on your screen. But a lot of people trade during the overlap. That's around 12 to 1 because there is overlap because the Bank of England is open, the Bank of US is open. There is much volatility. As I said, when I say volatility, there is much money in the market. So during this time, the market just move up and down. So you can just when you are scalping, this time is very good for you to scalp. Let's move to the next time. I'm going to move on to what who moves the market. We've understood what moves the market. We've understood the structure of the market. Now we are going to move to who moves the market. When I say who moves the market, we have banks and institutions. The banks and institutions, what they move price. Retail traders, we don't move price, we follow price. So you have to understand liquidity. Liquidity is the money. Where is liquidity moving? Where is money flowing? That's what you follow. You see a lot of traders saying the trend is your friend. They are following the market. We follow price, but the banks and institutions, what they move the market. Right? Let's move to the next. So key takeaways. If you've not been from the starting of the video or you've moved the video so that I can just reduce stress. So this ending, I made this ending so that if you've not watched throughout, this will just be a summary for you. You can take something away. So the key takeaways. So Forex is the largest global market today. You know that Forex is the largest global market. And currencies are traded in pairs. You can't say you are trading USD, you are trading Euro USD. Currencies are traded in pairs. Central banks what influence liquidity. Central banks The liquidity is what money. They put the market. They put money in the market. They influence the cash flow in the market, right? Interest rates are powerful drivers. Although we learn what moves the market, that's economic news, political, geopolitical events, and others. But we also know that the most powerful of them all is what interest rates, which is interest rates, right? Economic news, that's NFP and all that. Interest rates are powerful drivers. When you talk about liquidity determines movements in price. When the liquidity, which is money, when there is more money in the market, what it determines how volatile the movement, and also what it reduces the cost of what placing a trade, right? So the key tell is, so now someone will ask discussion. So I just made this part so that we can just answer some questions. So why do interest rates? Someone will ask, why do interest rates affect currency strength? So interest rates can affect currency strength because higher interest what attracts foreign capital seeking. So when you have a higher, why do interest they affect the currency strength? Because when there is low rate, the currency is less attractive. So when the interest rates they affect the currency strength, that when there is high interest rates, what it strengthens the currency. But when there is what low interest rates, what it makes it less attractive. Let me use the word less attractive. When the interest rate is high, it makes the currency what more attractive. But when it is low, it makes what less attractive. When I say more attractive, that means what more investors are willing to invest in that currency, right? That's what I mean by high and making it the interest rates, how interest rates affect the currency. So why are major pairs more stable? So major pairs are more stable, such as the Euro, USD, US, because what there are more liquid, there is much liquidity, there is much money, so it is more stable. It's very, very stable. That's why what major currency pairs are more stable. There is much liquidity. That's all. So why is liquidity important in trading? Liquidity is what the money that flows into it. So liquidity ensures that traders can execute their trade quickly and with minimum price. It ensures that traders execute their trade quickly and with what minimum price. The cost is what very minimum. When you have much liquidity, as the major pairs, they have what low spread, high volatility, right? Because what they have much liquidity. So who has more influence? Banks or retail traders? I don't have to answer this. Answer this in the comment section. Today is the one of the teaching forex, the basics of forex, getting the knowledge before placing your money in what you are doing. So this was the introduction to financial market. The key takeaways: we spoke a lot, spoke about what forex is, spoke about what moves the market, who moves the market, the structure of the forex market. If you want more educational content like this, just click in there, just click, turn on your notification and click on the subscribe button so that we can create more content like this. Share this video to any beginner who is in the who wants to learn forex, that the person should first understand the knowledge before putting his or her money in it. So this platform or this channel is for people who are ready, who are eager to learn the knowledge first before they put their money into it. So I hope this video helped you, and share it to others to also capitalize on this market. Peace out.